The only trading video you're ever going to need to watch, ever. Been doing this for 30 years, and I'm gonna impart all of what I've learned over to you as quickly and as simply as possible. Hey, it's Coffee with Rob. For those of you who don't know me, my name is Rob, and for those of you who do know me, I'm still Rob. Somebody told me to say that in the comments, so there you go, Coffee with Rob. Today, I'm going to take you to the charts, and I'm going to show you the system that'll give you a high probability trade. I'm going to show you a high probability system that'll work for the price action system that everybody uses in the market. So many people use it. It's quite insane. And then I'm going to take you to the strategy that's actually going to make you the money, because the squiggly lines and the system that I'm going to show you and all the systems in the market, they all work. They don't make you the money. What makes you the money is having a plan, having the right business plan, approaching the market with the right psychology, and having a proper strategy to make you the money in the market. I'm going to take you and I'm going to show you that today so that you actually understand how to trade in the market. So let's go and have a look at the price action system, and then I'll take you and talk to you about the strategy of trading. The system for trading is easy. In fact, I could teach that to a primary school child with ease. The system is straightforward. That's just in the charts. But the strategy is what you need to learn at the end of the day. And the strategy I'm going to give you at the end of these charts. Then we're going to go over the strategy in detail as to how you're going to make a profit in the markets. The difficult part, the easy part is this. This is the part that you just need to have a high probability trade. Now, you've probably been on a few courses, and you've learned systems, and you've learned high probability trading, and they've told you that that's how you're going to make your money. But the truth of the matter is, this is not where the money is made. The money is made in the strategy. But the high probability trade is pretty simple. If you look at this chart, you can clearly see in this chart that there's a resistance that I've drawn in here and a support that I've drawn in here. Where did I get that? You simply take it to the line chart and you take it to the daily. Why do I go to the daily? Well, it's quite straightforward, really. On the daily, you've got more reliable information than on the lower time frames. If you drop down to a 5-minute time frame, for example, you've got very unreliable information. And if you go up to a day, you've got much better information. Think of it this way. If you had 5 traders in a room testing a system out, your sample size would be 5 traders. And if 3 of them won and 2 of them lost, you'd think, well, that's a good system. But if you were to take 100 traders and put them in the same room, and then you would have a much bigger sample size and you'd get a better result out of it. So if 80 of them lost, then you'd know you've got a 20% win rate on that system. So the bigger the sample size, the more accurate the information. Same with the time frames. The higher the time frame, the bigger the sample size, the more traders are in that day, the more reliable the information. Now I take it to a line chart on the day so that I can get the closing prices instead of the highs and lows, because it's important to use the closing prices to get your information. Once you get your information off the closing prices, you get a clear indication of where your resistance is. You get a clear indication of where your support is. You draw these rectangles in. These rectangles, the reason I draw it in a rectangle and not in a straight line is because this is an area where there's money. This is an area where there's money. Every time the price gets here, it bounces away. Every time the price gets here, it bounces away. Because there's money lying here, and because all the other traders are looking to buy here. Here, all the other traders are looking to sell here. It's an area where traders are looking to get in and out. This is a trend support. And why do I draw trend support in? Normally, you're looking for 3 contact points. I draw trend support in because if it breaks the trend support, then I know that it's changed direction, and we've got a counter trade, because we trade 3 ways. We trade number 1 with trend, number 2 with range. This is a range. That's a trend to the downside. This is a range. And number 3, we counter trade. Counter trading is important. Now you have how to draw the lines in. Now we go back to the H4, the 4-hour charts. I like to trade on the 4-hour charts because I can look at a trade, I can go out, I can leave it, I can come back, and I can see how the trade is done. A good example is, let's say you were trading on, what are we on here? Brent. On Brent, you've got this resistance at the top. You've got the support at the bottom. So Brent's been trading in this range between the 70 and the 85 for quite a while now. It went up in a bullish run, turned around, came back, broke through. You see there was a trend support running through here. It's broken through that and it's come back. Now it's also broken through this, what was a demand area of money. It broke through that. Came back, retested, carried on down. Pretty much a short trade all the way down to this point here. But then it broke through a trend resistance. Broke through here. So we took a long. Started to fail, but came back to retest. Now it's going long again, heading to the upside. It's broken through the trend resistance, looking to the long side. So that's a counter trade. How do you trade your normal trades? You can take just about any trade. And if you've got a red candle coming out of your resistance, you can just go short. If you've got a green candle coming out of your support, you can just go long. You can wait for the retests, but that's long and that's short. Same on your trends. Green candle up, go long. Red candle down, go short. If it breaks through, as it did on the Brent, if it breaks through that, you can go short. If it fails, comes back, goes through, then you need a stop loss here. Keep your stop losses close to your heart. Just showing you on this one that here it broke through that trend's resistance, and that's now going long. So it's counter trading. It's trading against the trend. If you wanted to trade with the trend, every time it came off that resistance, you go short, comes off that resistance, goes short, comes off that resistance, goes short, breaks through the resistance, go long. Same here, red candle comes out of that area, go short, green candle comes out of this area, go long. Same on your trend, on your resistances here. If a green candle breaks through this area, goes up, comes back, retest, you go long. Let me see if I've got any of those here. Here's an example on gold. I drew the resistance in here as a line, not a rectangle. You can do that as well, but this could be in a rectangle. Doesn't matter. Price broke through the resistance. Big green candle, that's long, but it's going to come back because of that. There's a whole bunch of sellers that got back in there. It's going to come back and retest this area. And if you get another green candle, you can go long on that trade and it'll go to the upside. Here's your big trend support. If it breaks through that trend support, it'll go short. But it's been bouncing off it, so it's long, 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 long every time it bounces off there quite easily. And this is structure. It's like you see the market goes up, comes down, goes up, comes down, goes up, comes down, goes up, comes down. But it's going up in structure. So you've got a buy, a buy, a buy, a buy, another buy, come back again, another buy, keep going up. That's how the market generally will make you money. But this is not what makes you the money. The squiggly lines, the maths doesn't make you money. The strategy is what makes you money. Go and listen to the strategy that makes you money. This will give you a high probability trade, because when you want to take a trade, you want to take a trade that's going to give you a high probability of actually going in the direction you want it to. So that's why you use these systems in the first place. But then how do you make the money off of those systems when you're trading? For that, you need a business plan. For that, you need a strategy, and you also need to get your psychology right. That's why so many traders lose in the market. So go and listen to my strategy after this charts and figure out how you actually will make the money in the markets. That's why I say this is the one video that you need to watch if you're trading. Go and listen carefully, and go and follow that procedure, and that will make you profitable over time in the markets on any time frame, on any instrument, in any place. So now you've seen the system, now you know how the system works. Now you have to understand a little bit more about the markets. And one of the big things you have to understand is all those lines and all those candles are not what make you the money, because squiggly lines don't make you money. What makes you money is the fact of understanding that the market is made up of traders. The market is made up of human beings, lots and lots and lots of human beings, and they all want to make a profit. Every single one of them wants to make a profit. Would you believe that? Can you imagine anyone getting into the market to trade and believing that they're going to lose? You see, the thing is, 60 to 80% of traders lose money in the market. And by the way, if you don't like losing money and you don't like risk, you probably shouldn't be trading. But did you even know this statistic, that on day trading, on the 5-minute charts, 99% of traders actually lose money? That, if you think about it, is quite insane. That's a huge amount of people losing. Yet, you do a course, and on that course, they teach you that the system that they're giving you is a high probability system that's going to give you a 7 out of 10 win rate, and somehow or another, you're going to be a winner in the market. Now, we all want to believe that we're part of the 30% of people that win. We don't want to believe that we're part of the 70% of people that lose, the 80% of people that lose. We want to believe that we're part of the winners. We don't want to believe that we're part of the 99% of people on day trading that lose, We want to believe that we're that 1%. We're that clever person who's able to trade so well that we're going to beat everyone else with a system that the guy with the Lamborghini showed me, right? That's how our psychology works. There's nothing you can do about it. And it's totally understandable. It's who we are. We're human beings. The other thing that we all have is fear. Unless, of course, you might be one of those psychopaths who doesn't have fear and you don't have any emotions and don't have any feelings. Good for you. But most people have fear. And that fear is what's going to cause you to lose in the markets. Also, we have FOMO, fear of missing out. That FOMO is going to cause you to lose in the markets. So you're going to go on your course and you're going to pass the course with flying colors, and you're going to come home and you're going to say, I know everything about trading, and you'll be using all the abbreviations like most people do. Suddenly abbreviations make you a genius at whatever you're doing, shortcuts or whatever the case. I can trade the XYZ and I can do the ZFW and so on and so on, and I'm an absolute genius at trading suddenly because I know all the terminology, because I know all the little abbreviations, and because I know what a candle is, and I know that there's a mathematical algorithm that does this. You don't realize, and the thing they never tell you, is that the markets are more subjective than you will ever believe. You think they're objective. You think they're a mathematical calculation, and you're looking at it like an algorithm, and you're looking at a lines, and you're thinking, when those lines do that, the market should do that because it's made up of this mathematical equation and so on. When in fact, that's got nothing to do with trading. That's just your charts and your maths. It's not going to help you with trading at all. You see, you don't understand that human beings do the trading. Even if there's a bot ahead of them, even if they've invented a bot that does the trading, there's still a human being running it behind the scenes. It's got his little system and his little way of trading, her little way or her little way of trading. And that's how the markets are traded. The markets are not traded with maths and algorithms and things like that. That's just a program that you put together so that you can see what's happening in the market, so that you can actually follow what other traders are doing. When that candle makes that big red line, or when that candle makes that big green line, do you think that is some kind of mathematical equation, or is it a bunch of traders buying and selling? And if you answered that question correctly, it's a bunch of traders buying and selling, then you're starting to understand a little bit more about trading in the markets, because you're trading against someone else. That's what makes the market 50-50 game. The markets are 50-50. There is no such thing as having a win rate and then being better than everyone else in the market. If you can boast about a win rate, that's great. But having a win rate is not going to make you profitable. If you've got a 7 out of 10 win rate, an 8 out of 10 win rate, and you think you're good at trading, go and have a look at your profitability and then decide whether you're good at trading. Because you see, what you're doing is you're believing that because you have a win rate, that you're actually winning. But what's happening is you win 8 trades out of 10, and on those 8 trades, you win $10 on each trade. And on the other 2, you lose $100 on each one. So you've effectively lost $120. Work it out. It's maths. You said the stock market's made up of maths, so there's your maths. That's the problem. You have to try and figure a way around this. You have to try and stop this from happening. So you've got your high probability trade. You've got your system in place. You've learned your system. You've done your course. You've even figured out from me how you can trade with a high probability system. So you're going to take that high probability trade and you're going to go into the market with real money, and you're going to think, but why am I losing? Why am I still losing? I'll have to change my system. I must try a different system. I was going to try that dude's system, or I was going to another course and pay another, I don't know, how much do you pay for a course? You tell me. Now you've paid for all these courses, you've done all these systems, and yet you keep following this repetitive cycle. You keep going round in circles and coming back to the same thing. You win a few trades and you start losing again, and you start wondering why. You keep thinking it's the system, when in fact it's not the system, it's you, it's your psychology, and it's your plan. 9 times out of 10, every trader that goes on a course, learns how to trade, gets into trading with no plan. Just like, oh, we're going to start trading now, and we'll win a few here, and we'll lose a few there, and we'll win a few there, and so on. And at the end of the day, there is no plan. You don't even know how much you're losing. You don't know how much you're winning. You're just trading. And you know you're winning a few, and you know you're losing a few. You know, scalpers are the best example of this, where they claim a win rate. But it's easy to claim a win rate scalping, because the minute you go into a win, you take your profit, so you kind of won. And then when you go into a loss, that's the trouble, is when you go into a loss, and then you want to hold it because you don't want to show any losses, so you keep on holding it, and then your dollar cost average, and then you push the stop loss away, and so on, and then the loss becomes gargantuan, and it wipes out all those beautiful wins that you had, all that hard work that you did to get those wins. So the way around this and the strategy to fix this is actually pretty simple. All you have to do is say, all right, I'm going to risk 1% of my account on every single trade. This is what I do. If you want to change that percentage, you can. If you want to be 10%, you can. 1%, you can. 2%, 0.5%, doesn't matter. I use 1%. Let's say you have a $100,000 account, and I know I'm going to get flack about this as well. You're like, oh, some of us can't have a $100,000 account. And then the same question you ask me, can I make a living out of trading? What I want to say to you is, of course you can make a living out of trading, but if you want to make a living out of trading, don't you think you've got to have some kind of capital amount to do that? If you were to start a cafe, a shop, that sold sweets, wouldn't you need some capital to start that shop? Do you not see trading as a business? It's a business. So if you want to make money out of it, you're going to need some form of capital. So I would say that a decent size of capital will make you more money and you'll be able to make a living out of it. And the other question is, how much is a living and how big is a living? Just remember that you can also go bankrupt trading. You can do the other thing if you want to. You can lose big time. Most people lose, as I've told you before. How do you do this? How do you risk this 1% on this account? What you do, you have a $100,000 account, let's say. I'm using that as an example. Let's have some coffee before we get started. Now you've got your $100,000 account. You're going to risk 1%, which is $1,000. The trick is to risk the same amount on every single trade you take, and not to risk different amounts because you prefer one instrument over another. You've got to risk the same amount on every single trade. Question is, how do I work out what size my trade should be? How do I know how big my trade should be? Well, that's easy, guys. What you do is you see a trade that you want to trade. You look at that trade and you think, I want to trade that trade. Then you work out where your stop loss would be. What I call an invalidation area. In other words, you look for an area on that trade where you say, if the price gets to that area, this trade is no more. That's my stop loss. That's an invalidation. If it gets to that point, I wouldn't want to be in that trade. Now you've chosen your stop loss area. Now all you've got to do is work out how many contracts, how many pips, how many points do I need to buy to make $1,000 back up to the cost down to my stop loss. How many is that? And then you can work out the size of your trade. Now you know the size of your trade. It doesn't have to be exactly $1,000, guys. If it's $20 this way, $50 that way, it's okay. As long as it's close to $1,000. You want to try and keep the risks similar. And also you don't want to make $50 profit and make $1,000 or having $1,000 risk. You want your profit to be worth your while. Now, you've heard a lot of people say the 2-to-1, the 3-to-1 theory, where you make double what you lose, and this is how it works. It's like a coin toss. If you were to toss a coin 10 times, you would agree with me that the high probability is that you'll lose 5 and win 5. But if I told you you can win 2-to-1 on the winners and only lose 1 on the losers, anyone would take that bet. That's how you do it in trading. So what you want to do with your winners is make more on the wins and lose less on the losses. So now that you've got your stop loss set, you've got the size of your trade set, what you've got to do is look at the trade and say, if I put my trade at about 2-to-1, 1.5-to-1, 3-to-1, is that achievable? Is it an achievable target? Is there risk to reward? Can I make that kind of money? Because there's no point in just willy-nilly putting a 2-to-1 take profit when you know you're never going to reach it. It's got to be an achievable target. So you put your target in place and you say, well, that's achievable. Because I don't want to make $50 for a risk of $1,000. I want to make $2,000. So now you've got your trade. Now you want to manage that trade. So now the trade goes into a loss. Now rule number 1 is do not dollar cost average. And of course, when it gets to your stop loss, what did we say in the beginning? We said it's an invalidation area where you wouldn't want to be in the trade. So why would you want to move the stop loss away? Obviously, that's your stop loss. Take it. Walk away. The trade is now invalid. Just walk away. I recently have had a couple of trades where they've just been spiked out, and that's one of the most frustrating things you're ever going to face in trading. Live with it, deal with it, move on to the next trade. Now it goes into profit. Now it's $300 in profit, and I know you're itching to take that profit. Your fingers are itching like crazy. Your hands on the mouse, you're about to click, or on your phone or wherever you are. You're ready to take that profit because it's a profit, and you can't let it go. It's $300-400 in profit. You don't want to let it go. No, sit on your hands, or I don't know, do something. but don't take the profit because your target's up there at 2,000. Why would you take profit at 300 when you're risking 1,000? Best thing you can do, take your stop loss, move it up to break even, make you feel more comfortable. Now you're not losing anything. And just remember, guys, if it does come back and take out your stop loss, because you're going to get a whole load of those little profits where it comes back and take out your stop loss, don't feel like you've lost anything. Same way, you didn't gain anything if it went into a loss and came back to zero. You didn't gain anything. Same as if you go into profit and it comes back to zero, you didn't lose anything. You were never out of the trade. It's an ongoing trade until it closes. At least the trade is free if you're on a break even. Now it goes more into profit. It goes up to 1,000. Keep moving the stop loss up behind it. It gets to your take profit. It gets to $2,000. And you're looking at that and saying, right now I've made target, so I'm going to click out. No, don't click out. Move your stop loss right up behind it. That way, if it comes back and takes it out, as close to take profit as you wanted, you've made your target. You may have lost $50, $100. Just you've made target. If it goes through that profit target and it keeps on going, which it sometimes does, then you're going to be happy that you've made quite a decent profit. You're going to get all that money that wasn't on the table for you in the first place. That extra money. Do you see the difference between system and strategy? Are you getting what I'm saying to you here? Do you understand this? Have you figured this one out? I've been trying to push this over for such a long time. The market's 50-50, guys. No matter what your system, when you take a trade, the high probability trade, there's a chance you'll win, there's a chance you'll lose, because every single trader in the market wants to win. As I tell you, a win rate is meaningless. If you want to know more about that, go and watch my last video, which will tell you all about it. And don't forget to come back for the live shows and enjoy the live shows. Guys, I want to thank you for watching. Till the next one, cheers, ciao, and bye.